Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. We will start discussing Chapter 7, which is related to inventory and cost of goods sold. In Chapter 6, we present the idea of sales revenue and accounts receivable related to credit sales. Now let's talk about the other side of any sales transaction, which is the cost and the inventory. In this particular video, we are going to talk about inventory and costs with their concepts, and we are going to talk about how to measure inventory. Let's take a look at Harley-Davidson's consolidated statement of income or the income statement. On the income statement, Harley-Davidson reported net sales for 2019, 5 million plus. All the numbers in thousands, but I'll just read them as if they are just the numbers. And the cost of goods sold, which means it's the cost that directly related to the sales that Harley-Davidson made, is 3 million plus. The gross profit reflects how profitable their products are 2 million plus. So in this income statement, it shows that cost of goods sold is a direct subtraction from the sales. On the income statement, you will see that the inventories are reported under the current assets, which is in the net value of $603,571. Again, all the numbers are in thousands. So what is inventory? Inventory is a tangible property that is held for sale in the normal course of business or used to produce goods or services for sale. So when we talk about inventory, we would categorize firms into two big broad categories. The first one is called the manufacturers. So manufacturers would start from the raw material after producing, adding value, and generate the finished goods, which is the ultimate outcome of the production. So I'm going to use ketchup as an example. So let's assume our company produces ketchup. Okay, it's not a particular brand. Let's say just the tomato sauce. So our company would start with the raw material, which is just the tomatoes that collected from the farmers. And then in the middle of the production, there's a work in the process, right? You see, it's some of the tomatoes are being processed and in a half-produced status. And some of them are finished, so they are in our warehouse ready to be sold. Now, if you remember, balance sheet is always a snapshot of a company's financial status, which means on December 31st, 2019, if we count the inventory of a ketchup company, the numbers reported under or belongs to that account, the inventory account, would mean all the inventories that the company would have at this point of time, which is December 31st, 2019. So if you go to the warehouse, you will see different types of inventory, right? You will see the raw materials, you will see the half-produced ketchup, you will see the produced ketchup in a particular date because it's a snapshot of your warehouse, basically. So when you report inventory for manufacturers, the inventory would include the raw materials, the work in process, WIP, and the finished goods. Okay, so their inventory includes all different forms of their products. For merchandising companies, by the way, are just like Targets or Costco, right, or Walmart. They don't produce. They just purchase goods from another company and sell it to the customers. So for those companies, inventory is pretty simple. The amount of inventory included in their balance sheet would basically be the inventories in their warehouse. So they are all like merchandise inventory. So where do companies report their inventory information? It's usually in a note to the financial statements. So for Harley-Davidson, for example, they include an additional balance sheet and cash flow information for inventories, which they reported raw materials, finished goods, accessories, and so on and so forth. The total inventory is the summary of the above items. All right, so now let's talk about measuring, right? Measurements. How do we measure inventory? So we talk about recognition of inventory, which is for the manufacturing companies are raw materials, WIP, and the finished goods. For merchandising companies, those are the merchandising goods. But how do we estimate, other than recognition, how do we measure, right? We have to measure an account. So when we measure inventory, the rule of thumb is that inventory is initially recorded at the cost. So what are the costs related to inventory? The following are the costs that usually included in the inventory purchases. Obviously, invoice price of the product would be included, right? You purchase a book which is worth $100, then the $100 should be included in the inventory of the book. When you ship the book in, right, there is a freight in for delivery. So freight in charges for delivery. So that is another major cost. You would probably have inspection cost, preparation cost, and then you would subtract the purchasing returns and allowances, purchase discounts, right? It's the other side of when we talk about sales discount. When someone else give our company a opportunity to pay back in full within 10 days, 2%, we will take it, right? If we take it, that would count towards the sales, the purchase discount, sorry, not the sales discount, the purchase discount. So invoice price plus freight in plus inspection plus preparation, subtracting returns, subtracting discounts equals to total inventory cost. So companies should not accumulating purchasing costs when the raw materials are ready for use or when the merchandising inventory are ready for shipment. So it means that the inventory cost should be accumulated only up to the point that your inventory or your raw material is ready to be used. You can't add all the costs, keep adding costs to your inventory infinitely, okay? And so that is the cost for the inventory. All right, so one note that I want to make is called materiality. Sometimes companies do not include, although we said inspection and preparation, sometimes some of the inspection costs and the preparation costs are too small, very insignificant in amounts. For example, I'm a company producing ketchup. I'm also producing some other farmer goods, okay? Other than ketchup, I may be producing the blueberry sauce, okay? But I hire someone to inspect my tomato and my blueberries at the same time. I hire the same person. And that cost is very small. The person is only, I don't know, I'm just saying maybe $100 per day. And he or she does my inspections. Now, comparing to my raw materials, the inspection cost is very small. And I have 2 different or 3 different or 10 different products, which is inspected by the same person. So when the cost is really small, I don't want to bother to allocate the person's effort across my different products, that a series of different issues or questions. So when that happens, if the cost is very small, we call that not material. So if it's not material, we would just omit that and not assign those to the inventory cost. So you may see some companies ignore the inspection and preparation costs. It's potentially because those costs are not material. All right, in the guided video 7-1, you will see an example where companies, where the discussion leads to filling in the blanks in the income statement regarding sales and cost of goods sold. You should watch that video. I'll see you in the next video.